Welcome to this short video on depreciation. So for this video, you will definitely need a pen and paper for taking notes. It's not totally intuitive. You will forget, so you should write it down. That'll help you remember things and help you make sense of things. Also, you will need a calculator because I will ask you to try questions and make sure you understand the concepts. So if you don't have those things, pause the video right now, run, grab them, and we will get on our way. Yay! All right. So this video is about depreciation, and it relates to long-term capital assets. So long-term capital assets are those big ticket items that companies buy and use as they do the work, as they do whatever they do. Like cars or buildings, computers, furniture, also land. We're not going to talk about land right now because land is the only long-term capital asset that doesn't get depreciated. If we were running a daycare and we had all these play toys, they would be depreciated. And because the reason that everything but land gets depreciated is all these things will eventually end up in the recycler or the landfill, except the land. So we'll eventually use them up. So this part looks at assets that will be used for more than 1 year. So this depreciation is an adjusting entry, and adjusting entries rotate around that matching principle, where we have to match revenues to when we do the work, and expenses follow revenue. So if we use something when we're earning a revenue, we've got to record it in the same time period. And depreciation is an expense, and it's an expense because eventually we do use up all those long-term capital assets. So I want you to just use your common sense here. So assume that your company buys a new computer for $900 and you plan to use it for 3 years. Just kind of knee-jerk, how much does that cost you per year? Hopefully, you were thinking $300 per year. That's the cost of using that sucker. That's exactly the idea around depreciation. It's the cost, like what it costs to use the thing per year. And if that's a cost to use it, boom, that's going to be an expense. All right, so let's say you buy a computer on January 1st for $900. You plan to use it for 3 years. Well, if we think about that purchase in our asset category, we're going to add to our computer and subtract from our cash to buy this computer. It's just going to be an asset swap or an asset exchange. Then we're going to use that computer all of this year, and we know that cost is going to be $300 for the year. So our adjusting entry at the end of the year to make sure that we've captured all of those expenses looks like this. We're going to subtract out of depreciation expense in our stockholders' equity, and now we're going to have a new account under assets, but it's going to be a weird asset. It's called a contra asset, so it's the opposite of an asset. It's going to have a negative balance, and it's going to be tied to that computer account. So when we look at our balance sheet, because, on our balance sheet, that's where we report our assets, that's where we report this computer, we'll show that, yeah, our computer was $900, that cost principle we've been talking about, but then we'll see less accumulated depreciation. So the net book value is $600. On our income statement, we'll show revenues and expenses. And just like all of our other expenses, the cost of the things we use, we'll see that $300 as depreciation expense. So we'll subtract our expenses from our revenues to calculate net income, and this will reduce the net income for the year because, yeah, there is a cost associated with using this computer. Now, we're going to go on and use this sucker again for another year. So again, at the end of year 2, we need to make an adjusting entry. So in year 2, we're going to do the same thing because the cost of using it that year is going to be another $300. So we'll subtract it of accumulated depreciation and subtract it of depreciation expense. Our time period principle that we report in periods of time. So on our income statement, we're just going to look at what happened in year 2. Yeah, for year 2, it cost me $300 to use that silly computer. Another 1 out of the 3 years. Now on our balance sheet is a little funky because we're going to show that asset. We still have the computer. We bought it for $900. But now at the end of this year, we have accumulated depreciation of $600, representing 2 years of its life has been used up. Gonzo. And the net amount of the computer on our books is $300. Kind of what's left over. All right. So let's kind of change this up a bit. So assume that your company buys a new computer for $900. You plan to use it for 3 years, but then actually you think, holy smokes, I'm going to be able to sell that computer for $150. Well, if that's the case, really the full cost is going to be $750. Yeah, right now it'll cost you $900, but damn, you're going to get $150 back. So at the end of the day, it's going to cost you $750. So if there's a residual value or an amount you think you'll be able to sell the asset for when you're done using it, we need to factor that in. So if we're still going to use this computer for 3 years, in that case, the depreciation expense per year will be $250 because we're going to divide just that $750, that net amount of what this computer will cost. So make sure you have this in your notes. Our annual straight line depreciation expense is the cost minus the estimated residual value, or what you think you can sell it for, divided by the estimated useful life in years. All right, so in this case, same thing. In year 1, we're going to buy the computer, swap the computer for cash. Then our calculation for depreciation, the cost minus the residual, divided by the useful life in years, that's the annual cost. We'd use it for this full year because we bought it January 1st. So we're going to use it from January to December 31st. That's 12 months, a full year. $250, $250 minus. There's our balance sheet and there's our income statement. Year 2, same thing. We're going to use that computer all this year. So that's the annual cost per year. We're just reporting for that year on the income statement. So it cost me $250 to use that computer in order to serve my customers in this year. Now in year 2, my accumulated depreciation, because that account is not closed, this one's closed, these ones aren't, we've got a net book value of $400 showing on our balance sheet. Year 3, holy smokes, we've used this computer all year. This is my December 31st adjusting entry. I am so done with this computer at the end of this year. I am ready to sell that baby for $150. And look at that. My accumulated depreciation at this point would, or my net book value, at this point would be $150, exactly the amount I plan to sell it for. Now, you should have this in your notes. This is how you calculate depreciation. Easy peasy lemon squeezy. Now, I'm going to, of course, this is accounting, so I'm going to add something else, and that's the fact that you only depreciate something when you own it. So, and chances are we're not going to buy every long-term capital asset at the beginning of the year. So you're only going to depreciate that asset for the months you own it. A couple of practice questions. Load